So the participants on, generally speaking, I'm guessing on that I see in the chat, are going to have their own unique individual experiences. As I can see that there are some storage owners in the chat themselves, but anecdotally, obviously, what I've heard when talking with numerous owners and other developers, facilities both in the stabilized manner and in lease up, is obviously if you've got a facility that's anywhere near a college or a university, you've seen an extraordinary amount of demand in the near term as everyone basically went home. So on the net, high level, you've seen if you've got good college exposure, you've seen a lot of good net demand. I guess the question becomes, with some facilities being in that essential versus non-essential category of being able to stay open versus not stay open. Hopefully you're in a state where you've been categorized, like New Jersey, where you've been categorized as essential, and you're able to continue to bring people in and rent units versus, some I've talked to that are in non-essential classifications and they have to shut their doors. And so that's obviously,
I think New York is essential right now, aren't they?
Yeah. I think New York, Connecticut, and they're all trying to mimic each other. So I would assume that if New Jersey is considered essential, that
Safeguard mentioned that they were considered essential. So
do we have a list of non-essential states? No, we don't. I would probably point you towards the SSA on that. They probably have an aggregated list of who's essential and non-essential. But I can only imagine for the large operators how much of a headache this is creating in terms of being able to navigate if a state should be open or shouldn't be open. But so that's the first thing is are you able to navigate this as a function of whether you're able to stay open, which is essential versus non-essential. I guess the next thing I've been hearing, which I'm interested to know, and I don't really have an answer for it, is how the collections process will work. Because say you do have exposure to tenants that lose their job and stop paying, you can't foreclose on them over the next 90 days. So it's going to create kind of a very unique environment in that sense, in that even if you have, people that stop paying, it may create more problems around being able to get them out of the unit and sell their stuff and get a new customer in there. But that's all short-term friction. We don't really have a strong view on what's going on there because it's happening as we speak. But the credit markets is most notably where the discussions I've heard. Essentially, the way I think about it is the bank lending market and the CMBS market. So the CMBS market being that the market that most notably has been taking down or satisfying the stabilized facilities, the cash flowing facilities. The equity markets is kind of the proxy for the CMBS market, and the equity market collapse has kind of put the CMBS market on a complete freeze. So a lot of the people that were going to the CMBS market to try and get loans are now going to banks. And I think that has implications towards the development cycle, in that a lot of banks that ordinarily may have been providing capital to developers, because a lot of these stabilized facilities were getting their money from CMBS markets, are now going to be able to compete and take money from the stabilized markets and cash flowing markets, which is a little bit less risky of a play. So how that impacts development, it's going to be on a net negative for sure. To what degree is a function of bank by bank, I think. But definitely, I say, this is a near-term halt in development activity. We really need to see what the follow-through is of the downfall of the economic activity to know how much, in terms of magnitude, it stops development activity. But I would say that the debt markets are definitely they're still functioning in certain areas, especially if you have a stabilized cash flowing facility, but definitely going to put a hampering on development activity, which is a net positive for the industry. I think you could say, unless you're a developer trying to get a project done.
What do you think about acquisitions?
So the problem with acquisitions right now is it's tough to get a bank to commit to a loan with all this going on. So unless you've already got a firm term sheet from a bank, what I've been hearing is that it's very difficult to uh, close. And so unless you're an all cash buyer, I mean, if you're all cash buyer, that's great. But absent that, there are some transactions that are getting hung, getting pushed. Luckily, if you ask the person that you're selling it to for an extension, they're inclined to give it to you unless you have an all cash buyer behind you. So valuations, James will touch on that a little bit. I think, yeah, I'll let him touch on that. But long-term implications, anybody's opinion, but I think, like I said in the beginning, that this is going to be a net positive for the industry, just because the diversification of the tenant base across households, businesses, different use cases will play well. So Brian Underwood said, are any current buyers on the line who are rethinking their current transaction, retrade, terminating their equity or JV equity? That would be a question for anybody on the line. I don't know about that one. Does the current situation compare, or will it be the same as the 2008 crisis? So the 2008 crisis was caused by over leverage in the financial sector and capital and banks that were undercapitalized. So the whole system came to a crash, and banks were undercapitalized, which means even if they wanted to, they didn't have the money to make a loan. So I think this plays out in a very different way than the 2008 crisis. The 2008 crisis was a financial market collapse. This is essentially the demand side of the economy has come to a halt because everyone's gone to their homes. Banks are very well capitalized thanks to a lot of the things that the government has done to increase bank capital requirements. So they're going to come out of the situation, banks being in a well-capitalized situation, to where if they want to give a loan, they're going to be able to give a loan. So it's very different in my mind. The question becomes is, what does demand look like in the general economy as we kind of adapt to this new world? Obviously social distancing is going to cause people to be a little bit slow to get back to normal. But how does that impact self-storage? I don't necessarily, it's a question of how much your customers have been impacted, but it's very different than 2008 in my perspective.
In the short run, we imagine that demand for self-storage is definitely softens. We look at employment growth as a really good proxy for self-storage demand, and I can we can reference a paper we wrote on that a few years ago. I'm sure many of you saw that the jobless claims this morning were 3.2 million, 4x the size of any of the largest week prior to that. So huge number on the jobless claims, which will inevitably have an impact on self-storage, although obviously we don't know what the extent this package from Congress will have to mitigate that, but certainly expect some softness in demand here over the next several months. There's some questions on terms of valuations in the private market. There's probably not a lot of activity since this crisis really broke out in the private market. So I've got a chart here on the public markets, which sort of react more in real time, which I can bring up if I know how to do this. It doesn't look like I do though.
Just while James is pulling that up real quick, just to ask the entire crowd, I think we all have our own varying experiences. This is sort of definitely a very unique, wild time. But just to the open crowd here, if everyone wants to just contribute a thought on how they're how they're handling the the virus, how the virus may have impacted their business or facility. It'd be pretty interesting to sort of get a few different varying opinions on that in a few moments.
Ideas to retain customers in the short term, April, March. Panama City, Panama, non-essential. Well, non-essential, if you're non-essential, then customers aren't going to be able to access your facility, if I'm reading that correctly. So they wouldn't be able to come in and take their stuff, I guess, if you're saying that you're in a non-essential market. All right, James is up with his chart here. James, you back?
Yeah, I think so. This green chart here tracks the cap rates in the public markets for the publicly traded REITs, and it hasn't updated for it updates monthly, so it's not actually real time here. But I'll just pull up the green one here. This is actually the individual stocks is real time. The chart below it. So these are the implied cap rates for the four large public REITs. You can see they've had a large move higher. This would take the index roughly to about 6.5%. So up in this region. So not near the this 10.5 implied cap rate back in 2019, but sort of more in the 6.5, 7 range. That being said, though, the risk premium or the spread to the 10-year is, if we move this chart up, is more around 5.5, 6, which would be similar levels to the 2008-2009 crisis, meaning the public equity markets are pricing the largest risk premium into the self-storage stocks since that crisis. Now, obviously, they've come back in the last couple of days, but certainly there 3 days ago, you were seeing the largest risk premium put on the self-storage sector in the public markets since 2008, which is pretty remarkable. So those are my comments on the valuation side.
Yeah, I mean, having gone through this in 2008 at JP Morgan, when traumatic events like this happen, typically stock moves like this that occur are more a function of the market deleveraging than they are of individual views on the stocks themselves. So when you see these massive moves, they tend to scare a lot of people, but it has more to do with the market deleveraging itself, because there is a lot of leverage within the market in terms of hedge funds and everybody else. And when you have to take down and de-risk your portfolio, you have to reduce that leverage and sell a lot of those assets. So it does create opportunities like that. Not that we're advocating buying stocks, but certainly dislocations like that can occur in periods like this. So that seems to be what James is pointing out there. Jonathan, where are we moving next? You're muted now, Jonathan.
Thank you for calling that out. All of the data that James just walked through, that's also available in real time, obviously, on our website. So if you have any questions about any of that, please reach out to any of us, and we're more than happy to sort of set you up so that you can adequately view it. Yeah, I think David's last question there about sort of ideas to retain customers is pretty interesting. Just when you think about as it relates to like the incredible surge we saw this morning of the unemployment across the nation, that people are truly valuing their own expenses and things. Self-storage might be a place where they look to sort of remove themselves from. But I will say that Radius, ISS, SSA, there's a lot of different publication resources out there that are churning out some great content and ideas about how how you can do that, from like new technologies to like new marketing tactics to sort of reinforce how self-storage is really like a sector that already is set up in a position to be contactless, especially compared to other real estate sectors. So there's a lot of different things that, from mom and pop to larger REITs are doing to, to sort of reinforce the fact that, that they can be fully operational from a tenant perspective without having to contact anything physically and bring harm.
We've seen
to
a
them.
lot of announcements recently. Seems like everyone's been announcing an initiative to operate their facility without any human contact.
Yeah,
physical
David,
contact.
Yeah, David, I would, because storage is a need-based product, I would focus less on the retention, because to the extent someone needs to leave your facility because they lost their job or they no longer need the product, there's probably not as much of an ability to change that. I think, but the point being is with how you think about gaining customers in the future, with all the announcements about, the storage group can do it, CubeSmart, Life Storage, all these groups are coming out announcing that they can do contactless rentals. That's going to be, I think, key in how you strategically approach the market going forward and being able to acquire customers in this new normal where maybe you can't have your manager talking directly to the person. So you've got to have a way of which you can rent your units in some sort of virtual manner. And so I think that's a lot of, we've seen a lot of announcements, and I've seen a lot of interest, generally speaking. Talked with a couple of developers that are now really pushing aggressively towards that. A month ago they weren't thinking about that at all. OpenTech does some great stuff there. So there's a lot of products out there that, to the extent you can't get rentals done seamlessly over the internet, that's really an area where, instead of figuring out how to retain your current clients, I would focus more on how to implement systems so that you can get clients without human interface going
and
forward.
Sometimes a lot of these systems may already be implemented in a lot of the facilities. They just need to be broadcasted and reinforced. So, for example, Corey actually went to the Life Storage out in the Bronx, and we filmed a video about their Rent Now platform, which is a system that they're really excited about at the end of last year. And here we are in this pandemic where people are finding the need to rent online. So that's the system they already had in place. So they, the guys at Life Storage, they revamped that system and just reissued, a Rent Now version 2.0. And it's obviously it's a very poignant time for them to do so, but just the idea that these systems may already be in place. It's just about making sure that customers and tenants are aware of them. We do have a couple other questions here. Do you have an opinion regarding the possible drop in demand? What is the drop in demand in the 2018 crisis? I think Corey had some notes that he was tracking on sort of demand, and he touched on them at the beginning of the call, but I think he had some thoughts.
Well, James, you can pull up the historical occupancy and revenue numbers on the insider pages. Can you post those again? Because from a high level, I know I've taken a look at while James is doing that. Physical occupancy in the prior recession only declined from about 4%, but the question is what did economic occupancy, essentially what did, because you have a lot of bad debt during that period too. But if we look at the previous cycle, so same store,
we don't have our revenues going back that far at the company level. It's just but you can look at pricing and occupancy here.
Yeah.
You can look at pricing in conjunction with occupancy. You see pricing went from 5% growth essentially to negative 5%, and occupancy dipped about 400 basis points across the board. So, I think that's roughly. Yeah, I mean that's 10% certainly on the front end, but you've got existing tenants where you can raise rate as well. So revenue wasn't impacted quite as much, but certainly employment growth and lack of employment growth, negative employment growth is negative for self-storage demand. The reason being is that employment growth drives migration, and migrants are the consumers of self-storage, whether it's relocating for a job or downsizing or divorce or what have you. Migrants are the consumers. So
Yeah, I think the public storage, I've looked at these numbers before, only had 5 quarters of negative NOI growth.
yeah,
So it was a very short period of pain. And obviously they're diversified. So I've had people come to me and saying, well, the recession hit me really hard. Well, if you have one facility and you're in a market that's adversely impacted by a kept factory that shuts down, then nothing's going to really buffer you from that. But generally speaking, the industry did very well last recession. How could COVID impact the valet business in our view? Nothing would push it one way or the other from my standpoint. I think the valet business is a premium product. I did a call with UPS to go through what they're doing, but outside of that, I think the valet business is very much a premium product in self-storage. So I'm not sure that, you could argue that if people are trying to be socially distant, you don't want to have them come into your home to take your stuff away.
Yeah, I've seen a couple. I've seen a couple press releases already from a couple services that have sort of reinforced the fact that they're taking extra steps in terms of like the physical contact. They're maintaining their presence by pushing out a press release saying, "Hey, look, we're still operational for your dire store like moving needs, but all of our servicemen are wearing masks or yada yada yada." So I know that approach is popular.
this has got to be negative for Neighbor. I don't know if people are familiar with that business model, but where this is just a network of like Airbnbs and you can store it in other people's garages. You got to imagine people are less inclined to store in someone else's personal space in this environment. I know they just raised a lot of money here, so I guess a little bit fortuitous on the capital raise, but certainly gotta be. I gotta imagine that's a business model that suffers here in the short run.
Yeah, certainly when you're being discouraged from interacting with people, putting your stuff in their home is probably not one of the things that you're going to be inclined to want to do, with that being the undertone of what's being pushed on you.
On that, I was going to touch on just rates quickly. We're not seeing really much impact to self-storage rates yet. So we're talking about the stocks going down and demand slowing and all of that. We track rates here on a daily basis and haven't seen hugely impactful moves. This chart here in the bottom right would be the year-over-year change for across each of the public REIT portfolios. You can see public storage had a little move down, but the trend's still generally higher. And even as we dive into some of the other regions like New York and LA, who's sort of been the forefront of this, you haven't seen much significant softness. So perhaps no implications yet.
Yeah. Brian Underwood said, curious if you're seeing an influx of traffic on your site. Maybe it's too early. I would assume there are a lot of users of data, buyer centers, lender. I wouldn't say an influx.
Traffic's lower. I think people are on pause.
On hold for sure.
Trying to see see how this plays out, and yeah, people are scrambling for sure.
I think the mix of traffic has gone more towards larger private operators and institutional players have continued to pursue data, pursue projects from the activity we've seen versus the one-off, maybe smaller mom and pop or individual operator, individual developer may just be on hold. there's a lot of life events that are occurring, but generally speaking, institutions are still plowing forward with activity. And lenders, we still see lenders on the site. So activity's happening. It's just, I think the mix of activity is very different.
So that actually segues nicely to Brian's actually other question that he asked earlier. He asked, any current buyers on the line who are rethinking their current transaction, retrade, terminating their equity versus JV equity. I think it's very topical. I know that like people that are in the home buying right now have all sort of tried to refinance their homes just because everything's happening. But definitely,
you got to imagine that people that weren't selling before or were having these unrealistic expectations in terms of valuation. I know that was a lot of the conversation in the market over the last couple of years that that they're likely to come to the table here is probably. I mean, I haven't seen any. I don't know if Corey has. Probably maybe a little early for any signs of that. As Brian mentions, people are just sort of scrambling right now and trying to get organized. But you got to imagine, there's more opportunities come to the table here. Wouldn't you think?
I've had several discussions around pushing out due diligence deadlines and other deadlines in terms of closing. And I haven't heard any people walk away from anything yet. And I certainly haven't heard of sellers adjusting their expectations. I think
it's probably too early.
It's too early. It's too early. But so the net of it is that there hadn't been that much other than just deals are getting pushed, timelines are getting pushed, because I think the kind of general consensus with what we know is that once we come out of this in a month or two, then we'll figure out what we're going to do.
But I mean, these public REITs, although we talked about liquidity, there had that spike to 2008 on a risk premium. They're still off, 100 basis points. So you got to imagine these private guys that got bids, 6 months ago and we're saying no to them are like, now that cap rates are off 100 basis points, are like, oh wow, that would be awesome right about now. So I mean, I think high level, we're definitely moving through a cycle here into this next question on the screen. Development activity is going to slow. Right, we already saw it to sort of topping out to some degree, and you got to imagine looking forward over the next year and two that it'll continue to slow and net be a positive in the long run for the industry, but certainly that's offset by the demand headwinds in the short run as well. So most likely a classic cycle dynamics, unless this package from Congress really does just sort of everything just goes back to the way it was in a month. I mean, that's what everyone's hoping for. Highly unlikely, but if that's the case, then
you really juice the economy, and then people will really get back to business as usual. I think that the reality of that is probably low. Because people are going to adjust their risk premiums, just generally speaking, because it's not like this thing is going away.
Exactly. So you move out of a development cycle into an acquisition cycle. I think that's what these two questions are sort of like hinting at. But that's certainly what we would expect, is that development slows and people start to pivot to acquisition. I got a question for, I don't know how many, I lost the number, but I'm sure we have, a number of clients on that have used the platform and stuff. Certainly as we think about our business, we've really catered to the developers as those, inevitably slow. I think we are, thinking about how we can better serve perhaps operators. And I don't know how many of you use it on an operational or day-to-day business, but if there's any thoughts on how we can be more helpful on an operational standpoint rather than a development cycle standpoint, I'd be interested in any comments if they're out there.
Yeah, and furthermore, I mean, if everybody on the call probably has different varying perspectives on events that are happening to them and their what they're seeing from their niche market. So I would definitely encourage anyone to share some of that information as well. It could be insightful to glean on each other.
On the expense side, so Pocahontas just asked another question. On the expense side, what could be the impact on property taxes, Google, payroll, should the expenses ease? Property taxes. That's a difficult one. You know, governments are going to get hit by this, so I think that I don't see any significant changes in property taxes.
Well, the general trend on property taxes is that governments are trying to increase and reassess, you know, valuations and figure out how to get the most out of it. That trend is certainly going to continue. I can't imagine this would change that at all. That being said, if valuations are lower, the impact on property taxes based off of valuation methodology should become less of a headwind. So you've got sort of two counteracting trends there, which probably the net of are still upwards, as many of these haven't been valued in many years. So it's still an increase on valuation potentially.
Yeah. Google payroll. So if there's more unemployment, obviously, to the extent that you've got high payroll costs, certainly higher unemployment will help that. Google costs are more of a function of the development cycle, I would say. So to the extent that the development cycle comes to an end within a year or two, perhaps Google AdWords can be less expensive, but in the near term, you still have got the same dynamic where facilities are going to continue to be opening that have been underway for the last 18, 24 months and competing for that same flow of customers. So I don't think you're going to see anything.
Yeah, don't you think it could be worse on the Google side for the next 12, 24 as people are
for sure
are more panicked about filling the facilities and, you know, less demand out there? And
yeah, I mean, if you had an exodus of 5% in occupancy because people lost their jobs and had to move their stuff out, then you're more everyone is in more need of occupants, so could potentially increase the demand for AdWords. Would that rise the probability of Proposition 13 to go through then? That would be beyond my expertise, to be honest. I'm not familiar enough with Proposition 13 to want to stake a claim on any knowledge there.
Well, this has been super insightful. I hope. Definitely encourage more questions to come in. If anybody wants to unmute their line and share anything, by all means, we welcome that.
Another radius meeting in 3 weeks would be very valuable to see if people start paying the rents, occupancy changes. Unfortunately, it seems we're in the very early innings. Absolutely. We'll do this in the next few weeks and continue to canvass our client base and people that we talk with, from lenders and developers to operators, to give you what we're hearing, and hopefully it's helpful. And we'll definitely do that.
Yeah, I think it's pretty. I mean, it's pretty remarkable how things are shifting from day to day. So, you know, doing another one of these soon, just to be able to see how our conversations have even changed in a small amount of time is pretty crazy, just because things are so rapid. I do also want to say that I know Tao Zhao is on the line, and he's sort of our product expert at the time, and he's got a calendar link that I'm sure he'd love to share out, because he's going to be constantly doing demos of the platform itself, and you know, he knows all the ins and outs to help you with any questions that you might have. But would encourage you to use him if you do have any questions while using the platform. But yeah, I think this has been great.
Tao Zhao, you want to drop that link into the?
Yeah, I'll drop the link right now.
Yeah, if there's any way we can be helpful, you know, we'd love to hear from everyone. Comments, feedback on today's call or the product or anything. We're
if you want to see where Tao, we want to see where James pulled that data from, so you could see it on your own schedule. We can do that as well, and that's where Tao can help out. So
yeah, feel free to reach out.
Yeah.
All right.
Cool.
All right, fellas, back to it.
Yeah. All right. We'll update everybody on shortly about when we will be hosting another one. But in the meantime, thanks everybody for attending. It's been great. Enjoy the rest of your Thursdays. Stay safe. And we will talk soon.
Thanks,
Thanks,
everyone.
Jonathan.
All right, bye,
Thanks.
John.